a common factor to other assets that are equally sensitive to, that are also sensitive to those factors. And so if you model returns that way, then you can actually decompose the standard deviation of the returns of an asset as coming from different sources, right? So basically, with the multi-index model, you can say that the risk of an asset, the total risk of an asset, comes from different sources of risk, and each asset has its own sensitivity to those different sources of risk. Ultimately, you're left with an additional amount of risk that is called the firm-specific risk. And what about the one that is linked to all those systematic factors? How do we call it? What that type of risk?
The
Systematic risk. Yeah. And
Nice.
so if you think about this, well, you're familiar with Capm, even though we haven't covered it yet. Capm basically the measures risk as coming from only one source, and they call it what? Market risk or systematic risk. In that context, we kind of give them the same name. All right. So we have arrived to this thing where we can decompose risk in detail, and we're gonna leave it. We're gonna take a break. So now we're gonna cover the capital asset pricing model, and so this is the development of this equilibrium model. The specification of it and the way this model is tested is by using the single index model. So the single index model is the applied version of Capm to test if Capm actually works. And then what we're gonna do next is APT. And this is another model equivalent to Capm, but exists with multi-index models. Capm only works with one source of risk. APT uses a different set of treatment strategies of investors, a different setting for how the markets work. And it's a more complete model. Many say that APT is far superior to Capm. But how many of you have heard about APT before this class? And it's not uncommon, it's because most people don't know it exists. So you'll be among the few blessed with the knowledge of APT. So all of that basically leads us to, if you are a portfolio manager and you want to measure your risk, or if you want to measure your performance, how can you do it? Well, you need to use a model that somehow scales down the risk of your portfolio to that of an equivalent portfolio. And then you can see if your actual performance is in excess of what it should be given the level of risk you've been exposed to. So we're going to talk about performance and how we can use those methods to assess that. The last topic is going to be dealing with what if I want to protect my portfolio against shocks. So you can use options in conjunction with your portfolio to protect it from downside loss, downside price movements. But you can also create portfolios with options. And so what if I combine different calls or a set of calls and puts? What happens to my overall performance? So we will get to figure out a methodology that allows you to basically, if you remember the profit diagram for an option, well, if you have a combined set of options, your profit diagram will look like this. So that means that if the price of the underlying asset is outside of this band, you lose money, but you lose a little bit. But if it is within this band, you make money up to this much. So how can we create portfolios like that? So this is something where you're actually betting that the price of the underlying asset is not changing very much. It's relatively stable. So we'll figure out how to do all those things if time allows. That's pretty much what is left. Got it? All right. So, Capm was developed in the late 60s by Sharp, Lintner, and Mosin. And essentially they create an imaginary universe where assets behave in a certain way. So they make a set of assumptions. So I'm gonna give you a list of assumptions. If you look at your textbook, the list is much longer than this. They break them down one by one and kind of condensing them. So it's faster. So think of a market where investors are price takers. Investors plan for a single and identical. I'm so hungry now. Holding period. Like, I have some friends that believe in intermittent fasting, that they don't eat for like 18 hours. How can you do that? I mean, why would you want to do that? It's just, every time I do it, then the first thing I see that I can eat, I just eat it. If there is a bag of chips, I can eat that in 7 beers. I mean, just because, chips go here. Just delete that part. Non-alcoholic beer, of course. That's what I meant. All right, 3, investing universe is limited to publicly traded assets. Invest in universe limited to publicly traded assets, and borrowing and lending occurs at the risk-free rate. Four, markets are frictionless. Five, investors are mean dash variance optimizers. And 6, investors have homogeneous expectations. Investors have homogeneous expectations.
What's the third one say?
Investing universe is limited to publicly traded assets. Investing universe is limited to publicly traded assets. Borrowing and lending occurs at the risk-free rate. Yep. So, this is the way we are constructing this investing universe. Let's see what this stuff means. What does it mean that investors are price takers?
They take the price that's given on the stock, they don't set it.
So what does it mean? What's the implication of that?
They're not price makers.
So as an individual, I cannot trade and affect the price of a stock. The only way asset prices change is not by the actions of the person, but the action of the collective group of investors acting together. Okay? Yeah? So a single individual cannot affect stock prices. So what about the second one? Investors plan for a single and identical holding period. Well, we are basically creating a set of investors that are as similar as possible to each other. And like, if we all have different holding periods, I might have a reason to trade for liquidity reasons other than because I found an asset that is mispriced. So essentially, if everything is priced correctly, and you already have a portfolio, we're all planning for the same investment horizon, then if everything is priced correctly, then we would have no reason to trade. Once your portfolio is constructed, you're gonna keep it, okay? So essentially this implies that if an investor has a motive to trade, it's not for rebalancing reasons, but because he found an asset that is mispriced. Now, this part right here, borrowing, lending, occurs at the risk-free rate, that is just like we're setting the market to be. What about number 4? Markets are frictionless.
There's no negotiations going on in the background or anything.
So if you find an opportunity to make a tiny little profit, you will not incur any transaction cost. There is no cost for you to find information. Information arrives for free. And you're not gonna be taxed on any profit. So if there is a tiny mispricing of an asset, you will try to take advantage of it. Does it make sense? So if markets are frictionless, means that there are no taxes, no transaction costs, and anytime an asset is just slightly mispriced, investors will have an incentive to trade. Got it? Investors are mean variance optimizers. What do you think it means?
We're trying to maximize the mean return and lower, or get the minimum variance possible.
So basically what this thing is saying is that investors think in terms of risks to returns, like all the stuff we did in exam 1, right? So we're gonna see what the implication of that is. So all they care about is risk and expected returns. What about the last one? Investors have homogeneous expectations.
They have the same expectations of the future.
So investors they receive the same information and they use that to make forecasts. Now, since they are mean balance optimizers, so they don't think the exact same way. And so as information arrives and they think the same way, they will arrive to the exact same forecasts, okay? So what this model is trying to do is creating a setting where investors are described in this way. This is clearly, you might argue that it's not coherent with reality, but it doesn't matter, we are creating a fictional universe. Then, if you can come up with a model in this fictional universe, then we can test the model in the real universe, and if it works, that means that the model is somewhat resilient to violations in the assumptions. Okay, so this is pretty much the mathematical modeling process. You always start with something that is very restrictive, so that the model is as simple as possible, and then you test if it works. And if it doesn't quite work, you make little modifications, but every time you make a change, you're adding complexity to the model, right? So there is always a trade-off between how the assumptions reflect the real life and how much more complicated the model is going to be. If you have a model that rests on simple assumptions, it is very restrictive, yet it works, you solve the problem in the easiest possible way. That's pretty much what we're trying to get. All right, so once we have all these assumptions, what are the conclusions? So all those conclusions can be proven mathematically. We're not gonna do that, so I'm gonna give you a list, and then we're gonna talk about them. So the first part, A. Investors choose a portfolio that mimics the market portfolio. So I'm going to give you the conclusion, then I'm going to show you how we arrived to that in a minute. B. The market portfolio is the ORP, which stands for what?
Optimal risk.
Optimal risk portfolio for all investors. if you remember, how do you find the ORP on the frontier? By maximizing what, the Sharpe ratio. So just make an order here. The market portfolio. Maximizes the Sharpe ratio. That's how we find it. And then C. The market risk premium. Depends on the average degree of risk aversion. And the variance of the market. The variance of the market. And then last, D. The risk premium of a security. Is proportional to the market risk premium. And the assets covariance. With the market. Yep. Questions?
What's C say again?
The market risk premium depends on the average degree of risk aversion and the variance of the market.
Okay.
Yep. All right. You got it? Okay, so let's see. The first two together. So what all those assumptions are saying is that, let's see, investors are basically similar people. They all think the same way. They all have the same priorities in terms of what they value, in terms of returns and risk. And they can all borrow land at the risk-free rate, right? They can invest in the exact same set of assets. So from what we learned from the material in the first exam, in the graph between the trade-off between expected returns and risk, if you take all the possible assets, you build the frontier, and you have all investors at the exact same risk-free rate, investors will eventually identify the exact same ORP, right? Yep. And so if they all identify the exact same ORP, let's suppose there is an asset in this market that is not part of the set of assets, the set of weights that construct the ORP. What would happen to that particular asset? If it's an asset that is not part of the ORP, but nobody would want it, right? Everybody is better off by investing in this ORP. This ORP has a unique set of weights. So if you have done already your project number 4, you're only dealing with 3 assets because we want to simplify things, but you'll find a unique combination of weights that give you the ORP. given your own personal investment universe that contains only three assets. Picture this on a much larger scale. If I give you the exact same problem, you should all end up with the exact same answer, right? We are following the same methodology, so everybody should arrive to this conclusion. And so in this scenario, since this is the best risky portfolio for everybody, we're gonna call this the market portfolio. So all investors will arrive to that being the best asset allocation. Now, the assumptions do not talk about specific risk preferences. So this leads to part C. The market risk premium depends on the average degree of risk aversion and the variance of the market. Even though all investors are best off with this specific risky portfolio, all investors can also use leverage, so they can extend this capital market line. And the specific asset allocation for somebody who's risk averse is mostly T-bills and some of these M. And for somebody who is more risk tolerant would be mostly M and just a little bit of T-bills. So if you remember when we calculated the Y star guy, there was ERP in this case, M, because M is the portfolio everybody wants, minus 3 divided by A sigma M squared. This told you how each individual, given its dislike for risk, will allocate his assets between T-bills and the risky asset. Yeah? Well, picture doing this for all the investors in the economy. But if you add all those numbers together, the sum of the Y's in the story is going to have to be 1, otherwise there is going to be an imbalance in the market. And so in aggregate, you have that so for every investor who's borrowing, there must be another one that is shorting. Yeah, otherwise there will be an imbalance between assets. So you get that. So this is the average. This is the sum of all the levels of risk aversion. So if you actually compute an average, this will still hold. So what does this, if you rearrange this thing, you'll get, so for ERM minus RF, so what is going on here? This is the market risk premium, or the excess return on the market. The market risk premium is proportional to the average level of risk aversion and market risk. Where market risk is given to you as a variance and not as a standard deviation. Okay. So what is the conclusion of this? Well, let's suppose investors become more risk averse. So the average level of risk aversion increases. What should happen to the market risk premium?
Increase.
Should go up. So if as investors become more concerned with risk, they will invest in the ORP only if they're rewarded a little bit extra. Okay. What if investors remain the same but markets become more volatile? So if markets become more volatile, in order to remain invested in the market, investors will demand a slightly higher reward. That's pretty much the conclusion for this thing. Okay, so that's what, this is the part C. That's how this conclusion is arrived. Now, part D is complicated. Let's rewind a little bit and we said M is the one that maximizes the Sharpe ratio, right? So as an investor, if you invest in M, the reward risk that you have, the Sharpe ratio that you're exposed to, is gonna be this. Is here M minus RF divided by sigma M. Let's see. This is Sharpe ratio is the slope of this line. So this quantity right here is the spectral return of M minus risk free, and this is sigma M. Do you agree with that? So we maximize that fraction. You can write this in a slightly different way. Where instead of scaling down the market risk premium by 1 unit of standard deviation, you scale it down by 1 unit of variance. So this is the reward per risk, where risk is quantified as standard deviation. This is the reward per risk, where risk is quantified as variance. Okay, so those are two equivalent measures. It's gonna make sense in a minute why I'm using this. Now, let's suppose all of a sudden there is another security that shows up. And if this security lives here by itself, this means that this security has slightly less risk than the market and considerably less return. Do you agree with that? But when you compute the risk of a portfolio, what is that matters? It's not only the risk of the individual securities, but also what the covariance between them. So ultimately, the only way security can coexist in this scenario is if can coexist with them only if essentially it's a reward risk ratio is consistent with this. But the way the way we measure the risk is not by standard deviation, but by the covariance. So the way this can coexist is if the covariance between the security and the market. So this is the reward and risk of the security is equal to this quantity right here. So this is the reward of security I per unit risk, but the way we measure risk is in terms of how this security contributes to the risk of sigma m. So this becomes ERI minus RF divided by the covariance between the returns of I and the returns of the market. So those two quantities must be identical. Okay. So if you're adding an asset that is more risky than the market in terms of the way this asset is going to impact the market portfolio, that security is acceptable, however, needs to produce a considerably higher reward than the market does. So if those two conditions must coexist, this means that this quantity must be equal to that. Now you can rearrange it using algebra. And so basically solve for, multiply both sides by the covariance and then switch the order, and you get these. Times. So let's see what this means. The risk premium of a security is proportional to the market risk premium and this quantity right here. So what is this quantity right here? It's the covariance of the asset and the market. Okay. So now this ratio, the covariance between the asset and the market, standardized by sigma m, is what we call the Capm beta. Okay. So the way you have seen this thing before is like this. But let me explain a little bit more this thing. You have covariance between Rm and Ri divided by sigma m squared. This can be written as, the way you compute covariance is what? Sigma m times sigma I, correlation between m and I. Remember that? Divide everything by sigma m squared. Now you can simplify, you can write this as sigma I over sigma m, correlation I and m, and this whole thing is what we call beta. So what is the actual beta of stock? Beta is something that tells you by, there is a product between the total risk of I measured by standard deviation, scaled down by the risk of the market, and then multiplied by the correlation between the stock and the market. So for instance, if you have a stock with a correlation of 1 with the market, can the stock have a risk of a beta 2? The stock has a correlation of 1 with the market, can the stock have a correlation of 2? I mean, can the stock have a beta 2? Let me write it down because I got lost in what I just said. The stock, can this stock have a risk that is twice that of the market and a beta 2? Well, the only way for this to work is if correlation between the stock and the market is exactly 1. Do you agree with that? So the stock is twice as risky, but also moves in the exact same direction as the market all the time. So if you were to add that stock to your portfolio, what would happen? You would make your stock more risky. Why would you take something that is more risky than the market? Well, only if I'm taking something that is more risky than the market and their risk is linked to correlation, right? So this part right here. I'm willing to accept this asset that is more risky only if I get rewarded with something extra. Okay? So investors have this choice. They could invest in M and RF. And if they do, the trade-off between their return and risk is this. But if something else arrives their way, they would choose to add it to the list only if the covariance between the returns on the asset and the market which is by how much risk is reduced or added is compensated enough. Okay. Would it be possible for a stock with total risk that is 3 times the risk of the market to have a beta of 0.2? So can you have a stock whose returns are very volatile, yet its beta is low, according to what you see there? Well, let's see. Beta is sigma I over sigma m times rho. Yep. And we said beta of I is 0.2. Sigma I is what? 3 times sigma m. This and this cancel each other out. Well then, so for rho, if the correlation is 0.2 divided by 3, then this is exactly possible. So you need to pick an asset that has very, very little correlation with the market. Okay. So ultimately what matters in terms of systematic risk is not necessarily how high the risk of the stock is, but how the risk of the stock correlates with the risk of the market. You can have a stock that is incredibly risky, yet behave just like the risk-free asset. How is that possible? Well, that particular stock must have a correlation of 0 with that of the market. Does it make sense? So if you look at this model and you rearrange it, the way I would rearrange it is like this. The expected return of an asset is equal to, so add risk-free to both sides, plus, this is the nicest form. And then that. So if you remember, the way you started the capital asset pricing model is by just calling this quantity beta. So this is the way you saw it. Okay. So based on this, what is beta? Is a measure of systematic risk, right? And specifically, what kind of information does it contain?
How correlated you are, or how correlated an asset is to the
It
market.
basically takes the risk, the standard deviation of asset I, scales it down for the risk of the market, and then multiplies that times the correlation. So this essentially is a covariance between asset I and the market. That's what the beta tells you. But that measure is standardized, instead of just being the numbers that you've seen in your covariance matrix. That's why the betas are close to 1, 0.8, something like that, is because you're looking at this multiplier times a number that is typically between 0 and 1. Okay. Questions? You good? And so essentially, this capital asset pricing model tells you if investors are behave this way, then absent any new information, the expected returns of assets should be proportional to the market risk premium, risk-free rate, and the amount of risk that investors are exposed to. The higher the risk investors are exposed to, the higher reward investors will demand. So if you remember from your previous courses, we did this graph, right? Where you have the expected returns of an asset. So put this on the y-axis. I want to put the beta in the x-axis. This is a fixed number. This is another fixed number. So the risk-free rate is the y-intercept. When beta is 1, the asset will produce a return of Rm. And the slope is the market risk premium, the slope of this thing. Yeah. So in this universe, the prices of assets will adjust so that for every asset, given its own beta, all assets with exact same beta should produce exactly this return. What is this return right here? If this is the beta of asset X, all assets with this level of risk should produce the exact same returns, which is Rf plus beta X times expected market risk premium. Yep. So this is the way they arrived to Capm. If we had more time, there is the mathematical proof to do it, but it's gonna take quite a while, so we're not gonna bother with it. We would have to give up too many other things to cover that detail. So let's think about this. What if you have an asset? So now we are trying to use this model in real life, and let's suppose that we found an asset Z, with expected return that is less than what is predicted. By Capm. What should you do with this asset?
We should.
So this is, you're doing your own research, you just discovered some stuff about the stock, and you found that according to your information, that the stock should produce this return. But Capm tells you that stocks with this level of risk should produce what return? Right? So this is the fair level of returns that you should get for being exposed to this beta. Okay. So is this a stock you want to add to your portfolio, or one that you want to remove from your portfolio if you have it? For this level of risk, you want to be rewarded this little or this much? Same risk, higher rewards. Actually, these are the fair returns, rewards. So you want to be rewarded fairly, right? So this is not an asset I would want to hold. I'm not being rewarded enough for my risk. So probably it's an asset I would try to get rid of. So let's think about this for a second, how this will work. Suppose this is my current price, the current price of Z, the market price at this moment. And let's suppose that this is my long-term forecast about the price of Z. Okay, so this is the price level, my long-term forecast about Z. The stock is worth, will be worth X dollars in the future. So this is now. This is future, right? Do you agree with that? Can you use that and figure out the expected return of this stock? Or the expected return of this thing the way you calculate returns is what? Is the most recent divided by the old minus the old divided by the old. So in terms of timing, this is the most recent. Expected price of Z minus the current, the old, divided by the old. Do you agree with that? Yep. So normally you calculate returns by you looking at today's price minus yesterday's. Here we're actually looking forward. We're using a forecast of price and compare that with today's. So this is my forecasted return, and the forecasted return is coming from a forecast about the price of this particular stock. So let's suppose now that all of a sudden we figure out that, but let's put some numbers in here. So the expected price of Z is 120. The current price of Z is 100. So based on this, what is my expected return? So put 120 minus 100 divided by 100. This means expected return is 20%. I'm forecasting that this stock is going to go up by 20%. All right. Now let's suppose that this is 20%, but the fair return for assets with this level of risk is 34%. So given those parameters, that is possible, right? So you realize that your forecasted return on Z which is 20%, is less than 34%, which is what is fair. Do you agree with that? So, what is your conclusion? If you have Z, what would you do? If I have it, I'd rather have the rest of the assets with this risk because I'm going to be awarded more, right? So if I have it, sell it. You agree with that? So let's suppose we all figure that out, because this model is not talking about an individual, but it's talking about the whole collective choices. We are all the same investors. We all have access to the exact same information. So if we all have access to the exact same information, we can all figure this out. We all arrive to this conclusion. So in aggregate, what are we going to try to do? We're going to try to sell it. Let's suppose, I'm violating the assumptions here, but let's suppose everybody tries to sell. Eventually, what is going to change here? Well, not the forecast above the long run value of the stock, but the price, isn't it? So, as we try to sell it, the price of the stock, I guess a second afterwards, or as soon as we engage in trading, is going to drop. So if the price of the stock drops, what happens with the expected returns? Let's suppose the price of Z drops to $90, okay? So with this new price and the same long-term forecast, there was nothing structural that has changed about the stock. So what is your expected return now? But it's going to be, the forecast is still 120, but the current price has dropped to 90. So what do you get? 33%. 33%. So our trading action has changed the price, and the changing of price has led to a change in expected return. So as we trade, what are we doing? We are pushing the stock that is off the equilibrium, we are pushing it towards equilibrium. Does it make sense? The same thing could happen if the asset is producing a return that is too high for what it should be based on this model. Investors would do what? They would want to buy it. As they try to buy, what happens to the price? They're going to push the price up. and that drives this excess return down towards equilibrium. So that's pretty much what this model is implying. Under all those conditions, the relationship between the returns of assets and their risk is naturally pushed towards that line. And the equation of that line is this. Okay? Questions? So the way you've seen those things applied basically is, example. So you have done plenty of problems on Capm. This is just a review. Often the quiz on the stuff, this is gonna be super easy for you. But a stock has a beta 0.75. The expected return on the market is 14%. The risk-free rate is 2%. The question is, what is the expected return on the stock? So the equation that links betas to returns in this setting is risk-free plus beta and that guy. So just replace the numbers and that's it. Risk-free is 2, beta is 0.75. And the expected return on the market is 14. So, what do you got? 11%, is that right?
Mm-hmm.
Yep. Questions? So, what if you have several assets and you want to combine them together? How do you find the beta of the portfolio? Is the weighted average of the betas, just like you did in the single index model, right? So the mathematics of these is the same as that of the single index model. The message is different, though. This is telling you what is the level of which, what is the relationship between asset, expected returns and risk, so that investors don't have an incentive to trade. And if there is a departure from that, what should happen? Well, if there is a departure from an asset in terms of expected returns from this equilibrium, the natural tendency is that investors will start trading and their trading actions will drive the stock back towards equilibrium. Okay. So the question is, well, can Capm be actually used in practice? So can you tell me if this model is actually usable? So if I want to use this to figure out if assets are priced correctly, how would you do it? And do you foresee having some difficulties in actually using it? Which is the biggest challenge to actually implement this in real life?
Figuring out the risk.
So what is the relationship here? Is between what? Well, I lost it. Where did it go? What is the big E?
Expected return.
Expected. So this is a model that tells you if investors think in a certain way, and they all think the same way, then if we deal with forecasts, then the natural equilibrium is achieved when this is satisfied. But if I really want to use this model, I have no clue what you're thinking about a particular stock. So we cannot get expectations. Those are not things that we can actually get. So the practical implementation of these is we cannot test expectations. So it's untestable. I don't know what's in your head, right? And sometimes I'm glad that I don't know. So, untestable. So it's purely theoretical. But you've learned in other classes that this model is used. So we use it we modify it, and we use it in terms of required returns. So we're using the model in a way that we assume that it holds, that actually works correctly. And then if we know by survey, you can figure that out. What are the required return of the market? What are the TB rate? You can just look it up. You can use that and figure out what should be the required return of an asset with a given beta. But we are not actually using Capm. We are using a largely modified version of it. The underlying assumption in using this is that you take it as something that works, and then you are trying to use it in a practical setting. So some of the problems in D12, some of them will ask you what is the expected return of an asset. So you're using this version of it, so the theoretical version, the pure version of Capm. But then some of them will ask you what is the required return of the asset. Well, we are using the applied version of Capm, which is the same thing, but instead of using expectations, uses data that can be obtained by just looking it up. How much time do I have?
15 minutes.
15.
Okay. So just because this is so exciting, let's add to the story. So how do we test it in real life? So in real life, of course, we don't know what the expectations are, but we can look at returns ex post. So we look at returns after the fact. So we use and a single index model. Okay, so first of all, the Capm doesn't tell you what the market is. So that's another challenge that we have. We need to figure out what the market is. So to figure out what the market is, we pick an index. And typically this index is a large index like the S&P 500 in the US, or some other large index in other markets. So it's just a proxy for them. Okay, and then we look at the returns of an asset, subtract the risk-free rate, and mathematically, if you rearrange it, where is it? If you arrange this one, you should get this. Do you agree with that? And if you remember, you calculated this in different settings. We call those excess returns. Yeah. So we write it like that. The excess returns are actually historical data, so you can look them up. And then what you do is use regression. And so you take the x is returns of a stock, time t. And remember, when you do linear regression, you're estimating the slope and the intercept. So and then you have this error term. So when you establish this regression, when you run this regression, you're estimating the values of alpha and beta. And when you estimate those values, you test for alpha. If Capm holds, this means that this equation should be identical to that one. What is the value of alpha here? Can you write this as 0 plus beta I? Mathematically, I didn't change it, right? Mm-hmm. So when you do your statistical testing, if alpha is not different than 0, that's how statisticians talk, and then Capm is satisfied. If alpha is different than 0, that means that there is some other stuff in returns that is not captured by the beta. Okay, so that's pretty much the way they test it. So for Capm to be satisfied means what? This alpha should be 0. Questions? So mathematically, it's a pretty easy test to, I mean, out of all the stuff they do in finance, this is one of the easiest things to do. So if you look at different settings, sometimes they found evidence in support of Capm, sometimes they found evidence against it. The point is that we are not testing Capm even if we do it, because Capm lives in a universe of forecasts. This lives in the universe of actual returns that have materialized. And also, Capm requires you to use the actual true market portfolio. You're not using the true market portfolio because nobody knows what it is. And we're using a proxy for it, which is most likely a subset of the true market portfolio. Now, this stuff connects to your project, because as part of your project, which I'm pretty sure almost everyone is finished already, you have the risk with respect to returns. So you're gonna find these ORP, right? That is your task. But then you also have data about the S&P 500 and the Russell and possibly some other large portfolio. What is, in your opinion, what is more likely to happen? That the S&P 500 plots here or here relative to your graph? So your graph only contains 3 sectors, right? That's how you found the ORP. What is the most likely scenario, the one that is more in line with theory?
Inside the
Should be here or should be there?
here.
So inside or outside? Think about it.
Yes.
Think about it.
Think outside.
So whatever your answer is, tell me why.
I would say outside because it includes more assets in it.
Yeah, so the S&P 500 is far more diversified this thing. This thing is the best possible portfolio you can create if you restrict your investment universe to the 3 ETFs that you picked. What do you know about the investment universe? It's much wider, so most likely S&P 500 should be up here, should be outside. Because you have a sample bias in your construction of the portfolio. You're not using all possible investable assets. You're using a subset of only equity. You're not even considering bonds. You're just using a subset of equity. What subset is that? Well, it's the subset that are in utilities, staples, I don't know, whatever you picked, healthcare, your choice. So you're looking at a very, very narrow set of assets. So most likely, this is what you should end up with. Okay? But again, the theory that we developed is based on expected returns. The model that you are testing is over what type of returns? Realized, right? Realized, the real ones. But the way you did your forecast, the way you came up with the ER, your ERs, how do you calculate that? You didn't make your own analysis. I gave you a systematic way to do it, right? So how did you do it? It was by looking at the average of past returns. So you combine history together. This is not really a forecast. It's just the laziest of forecasts, assuming that things that happened yesterday will happen again tomorrow, right? But we needed to have an easy starting point, otherwise, I mean, this is not a forecasting class, so essentially the way you're constructing this thing is by looking at past behavior. So you're saying, this is the way I should have constructed a portfolio if I have this asset over that period of time. Too late now because, time has passed. So, but the theory was developed about people having specific forecasts made more accurately than just using past data. Questions? You good? Alright, so I opened the quiz. There is about 5 or 6 problems on this stuff. This is by far the easiest of the material so far. On Wednesday, we're going to start the arbitrage pricing theory.